we had the budget that was presented in February, the interim budget. Now, post the interim budget, a lot has changed. The political equation in the center has changed. Instead of a sweeping majority, the government is currently at a coalition. So a coalition government of sorts does have its pressures on the budget and the budget numbers. But the biggest positive has been the fact that despite the fact that it's a coalition government, the narrative is unlikely to change. The narrative is likely to remain pretty much the same. The focus on policy, the policy momentum will not really see a change. Now, apart from the other details on the budget, there are 5 key pointers you have to watch in the budget, 5 numbers. Now, these 5 numbers will give you a sense as to how the budget is panning out and how to read the budget. The first number the markets immediately look at when the budget is presented is what is your fiscal deficit number looking like. And what determines the fiscal deficit number? The nominal GDP number. So your fiscal deficit is your fiscal deficit divided by your nominal GDP. So whatever your nominal GDP is, if your nominal GDP is inflated, you can show a smaller fiscal deficit. If your nominal GDP is realistic, it might give you a more real picture of your fiscal deficit. So the first number that you have to keep an eye out for, like you see in this table here, is the nominal GDP number. Are the nominal GDP numbers realistic? So in the FY25 budget, the interim budget, the government had projected somewhere around 10.5% nominal GDP. So a very simple way of looking at nominal GDP is your real GDP plus inflation. So if you're having a 6% real GDP and a 5% inflation, you have 12% nominal GDP. Now, inflation has actually been fairly low. When you say inflation, wholesale inflation. So you have 2 types of inflation. You have retail inflation and wholesale inflation. When you look at the inflation in the GDP numbers, or what you call the GDP deflator, it is a mix of wholesale inflation and retail inflation. It largely comprises of the wholesale inflation number. Wholesale inflation number has actually been fairly weak in FY24, given global commodity prices have actually been lower on a year-on-year basis. But going forward, that normalization has already started happening, and WPI is now in positive territory. So if you see somewhere around a 10.5 to 11% nominal GDP number, that would be a more realistic number. So this is the first number you have to look out for. Is the nominal GDP number projected at around the same that it was projected at for the FY25 interim budget? This is the first. The second, again, is your fiscal deficit number. 5.1 was the fiscal deficit that was targeted for the interim budget. Is that changing? Is that 5.1 going up or going down, or is it remaining the same? Now, we feel 5.1 would remain pretty much the same. It might not really change, but there is still a reasonable probability where the government can surprise, positively bring that possibly closer to around the 5%. There is still a moderate probability of that happening. Now, why would the government want to do that? You remember we talked about bond inclusion a few minutes ago. We said bond inclusion is also a narrative you have to very closely watch this month. So from that point of view, the fiscal deficit number becomes important. We'll talk about that in another couple of minutes. So this is the second thing you need to keep an eye out for. Third, what is your tax assumption like? So your tax revenue, your net tax revenue, you will always have to look at it. When you look at a budget, always look at tax revenue numbers, not in year-on-year terms. For example, if you look at year-on-year, the government had actually budgeted a 12% growth in tax revenue. Now, these numbers will change if your FY24 actual numbers get revised and get changed into the actual numbers. These year-on-year numbers will change. But what is more important for an economy is to try and see, is there tax buoyancy? So when you say tax buoyancy, as a percentage of GDP, your tax collections, are they going up? So for example, if your nominal GDP growth is 10.5%, for tax revenue as a percentage of GDP to remain constant, tax revenue will also have to grow at 10.5%. Anything above 10.5% will mean that as a percentage of GDP, your tax revenue collections, your tax buoyancy is seeing an uptick. So that is the most important. So in FY20, from 24 to 25, the budget had sort of priced in a marginal sort of a pickup in tax buoyancy. Is that happening? Is another number that you have to look out for. This is the third. Now, the fourth and the fifth are focused on the expenditure side. Now, you can always break up expenditure into 2 types. One is revenue expenditure and capital expenditure. And if you can see here, the total expenditure budgeted in the interim budget was roughly around 48 lakh crores. Of that 48 lakh crores, a large part of it is revenue expenditure, and around 11 lakh crores was capital expenditure. Now, as a percentage of GDP, remember, the focus should always be on percentage of GDP, not as much on the year-on-year numbers. As a percentage of GDP, is your revenue expenditure number going up? And more importantly, is your capital expenditure number, 3.4% of GDP, is that remaining the same or is it going up? I think these are the 5 key numbers you will have to look at when the budget comes out and the final numbers come out. These are the 5 numbers that will tell you what the budget is like. So how do I read these 5 numbers? How do you put these 5 numbers together? First, is there a realistic nominal GDP assumption? Second, is your fiscal deficit getting better, or is it the same as it was projected in the FY25 interim budget? Third, are you seeing tax buoyancy? Tax buoyancy would mean that the government is expecting the economy to also continue at a good steam and see some progress. And lastly, what is the expenditure mix like? The budget had a fair bit of a focus on capex. When the interim budget was announced, they pushed up the capital expenditure numbers by roughly around 17%, taking it to 3.4% of GDP. So this mix, is there betterment on the capex number, or is it exactly the same as the interim budget had projected? So these are the 5 key pointers you will have to look at from a budget point of view. Now, apart from these budget numbers, from a budget narrative point of view, what can come, what can change, and what has actually changed in the last month or two? Now, every year the RBI announces the dividend, and this year also the RBI announced a dividend. So the RBI announces a dividend for its financial year that ended in March. Now, when the payout happens, the RBI payout happens in the financial year of FY25. So somewhere in the month of May is when the end of May is when the RBI would have the government would have also received a payment from the RBI. Now, what was a big surprise for the markets is that the markets had priced in somewhere around 850 billion. It had budgeted in 850 billion of dividend from the RBI for its FY25 budget when it prepared the interim budget in February. But the actual number that came out was roughly around 2.1 trillion in RBI dividend. Now, this is an excess of roughly around 1.25 trillion. Now, from the interim budget to the budget that will be presented on the 23rd of July, there is an extra amount of money that the government now has, which is 1.25 trillion. Now, the question is, where can this 1.25 trillion get spent? Now, this is where the election result comes into picture. The fact that there is a coalition government, and possibly the fact that the government might see there to be a little more need to spend a bit more on the revenue expenditure side while not really compromising on the capex number. So one thing that one can say for sure is this political dispensation has been fairly prudent on the fiscal side, has been fairly prudent on the consolidation, of the fiscal consolidation front as well, and has been making every effort to give a bump up on the capex front. They understand that from a sustainable point of view for the Indian economy and for growth, focus on capex becomes very important. Now, 3 areas where you are likely to see focus of this 1.25 trillion is one on PM Kisan, on MGNREGA, and your PMAY. So your PM Kisan is largely income support to farmers. Your MNREGA is rural employment guarantees, and your PMAY is Awas Yojana, is housing for rural and urban. Now, these 3 are likely to see a fair bit of allocation. So going by market estimates and analysts of other economists, you can expect the 600 billion that was budgeted in the interim budget to go up closer to around 900 billion or even higher. We don't really know the exact numbers, but these are numbers that you get to hear in the markets. MGNREGA going from 860 billion, probably higher, to closer to around 900 billion or above, and PMAY going from 800 billion, again closer to around 900 billion or above. So these are 3 areas where there's a very likely possibility of this extra 1.25 trillion of RBI dividend getting spent. So a quick recap on the budget part. 5 key pointers you need to really look out for in the budget. One is, what is your nominal GDP growth assumption in the budget? Second, what does your fiscal deficit number look like? Third, what is your income, your tax revenue as a percentage of GDP? Is there tax buoyancy that the government is pricing in? Fourth, what is your revenue growth assumption like? What is revenue as a percentage of GDP? Is it actually moving down? Revenue expenditure, I'm sorry, moving down? Is your capital expenditure, is that going up from a percentage of GDP point? I think these are the 5 pointers. The second thing to watch out for is this extra 1.25 trillion that the government has received from an RBI dividend point of view. Where all is that incremental spending getting reflected? We feel PM Kisan, MGNREGA, and PMAY are three key areas where you can possibly see this incremental revenue being spent.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.